Hello, everyone. I already see here Dirk as well. Thanks for connecting.
Nice to see you again, Jaime.
All right. So, well, in any case, we're going to wait 3 minutes until we get started, so everyone has time to connect. Change as well. View. Better. Okay. Let's give around 3 minutes until we get started. I'll write it here on the chat too. Right. I'm also waiting for Christian, if he joined already. Okay, for the people that are joining now, we're gonna wait a couple more minutes until it's more or less stable, the people that connected. A lot of people signed for the webinar. So we're gonna give it a couple more minutes. Okay, give it 1 more minute. Also waiting to confirm that Christian can join. Okay, I see some Build 38 team. I'm not sure if it's Christian there. Are you there?
Yeah. Yes.
Perfect. Great. Happy to see you here. Thanks for connecting. I think it's 5:03. I guess there are some more people probably joining, but I think we can more or less get started. So, well, first of all, thank you very much, everyone, for joining, especially to Dirk and Christian, our guests today. So I'm gonna do a brief intro on ourselves and on them, and then we're gonna be like tackling some questions first, like startup side, VC side, startup side. The more like conversational, the better, obviously. And also, everyone is absolutely welcome to ask questions. So please either like write on the chat or use the function of raise hand in Zoom, however you guys want. But yeah, I know Dirk and Christian for a while, so I guess it's more interesting if you guys ask for your own questions. So, well, first of all, on us, for whoever that doesn't know us, well, I'm Jaime. I'm the CEO of the Startup CFO. What we offer is fractional CFO services to startups that still don't need a full-time position for that. So we cover everything from reporting, forecasting, but also controlling. We run audits, intercompany issues, all that stuff, but also strategic advice. So, for example, in Build 38, or in many of our clients, we participate in board meetings. We give recommendations on evaluation, funding rounds, a capital strategy, and all that stuff. In fact, already with Build 38 and with companies participated by eCAPITAL, we have been working already for over 3 years, if I'm not wrong, and definitely great collaborations. And the guests today are Christian Slager, Dr. Christian Slager, CEO of Build 38, that is going to tell you a bit more about it now. Welcome, Christian. And then also Dirk Sewald, a partner at eCAPITAL, venture capital investors in Build 38, and many other top-level companies in the deep tech and cybersecurity spaces. Also, thank you very much for joining, Dirk. So, well, starting with the startup side, I think it's interesting that we have both sides here. Starting with the startup side, Christian, can you tell us a bit more on you and how you like your career up to Build and a bit of like what's Build 38?
Thank you. Yeah, of course. So I'm not a startup founder. I'm an entrepreneur. Yes, did some startups and fundings in the past, but I started my career very boringly at Ernst & Young, and then moved on into the insurance space, and then founded together with Allianz, Bayer, BASF, and Volkswagen, the German cybersecurity organization in Berlin. That was my first kind of startup back then, but it wasn't a real startup as far as funding was not a real issue with these 4 companies backing it. And also there were no shares, there was no founder involvement, but it was a good time. That of course, and I learned a lot about the product, the market, and how these things could fit together. And then when I joined Giesecke & Devrient, G&D in Munich, I found something that caught my interest. G&D is a unknown company, I would say, but everybody has a product from them. Yeah? They are printing money. They have been inventors of the eSIM and the SIM card. They build credit cards. So probably in your wallet, you have at least one product of G&D. Over 11,000 employees worldwide, 3 billion revenue. So one of these German 100% family-owned businesses that no one knows, but that are really successful. And I started with them, and there was one product that I saw that didn't fit, and that was in my portfolio. I was the global product manager for everything that was not a SIM card or a payment card, and that was software security. And luckily, I found some others who also saw the problem of a SaaS business being sold by a hardware company, which didn't work at all for that. So we decided to do something with that product on our own and spin that out of G&D. So in 2018, a few things came together for us that made it possible what is now Build 38, and a SaaS solution that is working perfectly for banks, digital identity providers, automotive companies, and everywhere where you have a mobile app on Android or iOS or on a Huawei device that needs security. We integrate our technology inside an app and then protect the app, the user data, the channel, the backend for that. And that is working very well. But again, it is a security product that is using software and that relies on software security, and that didn't very well fit with a hardware company. So in 2018, we had 3 things coming together that founded Build 38. First was an idea about that product, that it could be enlarged, that it could be a cloud usage and so on. And then G&D, Giesecke & Devrient, founded GD Ventures as a corporate VC. And when they started, they looked at a few ideas, what could be done inside that area. And then third, the family, the owners, were willing to go really into supporting a new business idea. I need to take that one. That could be my just.
That's okay. We'll jump to Dirk. So Dirk, same question. Let us know a bit on how you like your career up to eCAPITAL and a bit on eCAPITAL.
Sure, happy to. Yeah, so this is an example of how we work together. Christian and I'm invested in Christian's company in Build 38. So whenever he has something, whenever he has a challenge, a call or something, so we jump in. So that's not a problem.
Okay. Very good example.
I'm Dirk Sewald. I'm partner at eCAPITAL, and eCAPITAL is a German-based B2B venture capital investor. We are currently investing our 5th fund generation. And we typically invest in Series A rounds. We do some seed rounds, and specifically in the cybersecurity space, we have done some particularly some seed rounds in the last years. Sometimes we do a little later, but Series A is our sweet spot. I'm personally an engineer by education, so I've studied electrical engineering, and I've been an entrepreneur myself. So I actually founded a company pretty much out of university in the telco space, in the optical communication space. This was in the 90s, even though I know I look much younger, but it was in the 90s. So I lived through the dot-com crisis and through the financial crisis in 2008 and 9, and been an entrepreneur actually for about 20 years before I jumped onto the other side, onto the venture capital side, fully only 5 or 6 years ago. And so, as I said, we are eCAPITAL, we are a venture capital investor. Series A is our sweet spot, Europe, and one of the first investors in Build 38, which Christian can now continue to explore a little bit.
Yeah, but Dirk is mentioning something very important, that he knows what we're going through. Yeah, and this includes family business, being part of your business, but also being an entrepreneur himself, that knowing the struggles of a CEO, that money is always tight, that they take hard decisions. This is something we value very much when working with them, that they have an understanding about what we are doing, or what, what's the situation there. Yeah, we as I said, we founded Build 38 as a spin-off from GND. Build 38 is already has named itself with that starting point. We build something for you to build on. We build something, software security, where you can build your apps on. We started in 3 countries right from the start: Singapore, Germany, and Spain. And we were 8 founders at the beginning. These 8 that were all working somewhere at GND. And when we started, there were a few rules that luckily our first investor set out for us to be successful. Mainly that it needs to be a real startup. That it needs to be a startup where we as founders invest money and buy the software from GND and are then separate from the corporate. This is, when I look at others in that market, Bosch tried a lot of that stuff, and they didn't give them the freedom to really be responsible for their business, and also accountable. Also always kept them super close, and that doesn't really work well with the venture capital and the startup world, is my experience from that. So we did that. Yeah, we invested our own money. We bought the software from GND, and then when we did that, the family via GD Ventures, they invested in us in a seed round. That was our first investment, end of 2018, and then we started business beginning of 2019 in that. And because of that setup, that you have real founders and also a good backing, we were very fast in acquiring our first customers. In June, we had our first customer already in 2019, and it was looking awesome. We thought we were the kings of the world, as you are at that stage in any company. Yeah? Money coming in, people saying they love what you're doing, especially friends of yours. Yeah, so you should read the Mums Test eventually. And then we were thinking about a first funding round. That's when I met Dirk, because so far with the corporate VC, it was a perfect start. But corporate VCs are different from venture capital VCs, of course. Yeah, there are a lot of things that you need to look out for when you have such a corporate venture capital company in your cap table. There are certain rules for reporting, as you well know. There are changes in the companies. It's not a fund that had a clear start date, end date, and a purpose. A lot of stuff are depending on certain politics, and something that we can discuss again in more detail. A corporate VC is not himself, the partner of that is not himself invested usually in the fund. So he's working as corporate. We were very, very lucky with our first corporate VC that we have a really good relationship, someone who's really experienced in the business and who's pushing us. But there is a difference to someone like, now we have two real VCs and two corporates, there is a difference in how they are managing the funds in your company, and how they feel about your needs, whether they are a corporate, a private equity, or a VC. For that, yeah, we thought beginning of 2020 it was a perfect time to raise money.
Wonderful.
And then Corona hit. Yeah.
Yeah, I started the Startup CFO January 2020 as well.
Perfect timing. So I remember the day, it was March 15th, when they had the lockdown in Germany, and people called me, and 3 term sheets I had on the table just vanished in 1 week. That was wow. That was a strong day for the company, but something where you need to get out of. Did a lot of changes, and good changes that we need to do at that time, going through a rough time. And then after a while, we started fundraising again, and in end of 2020, right, Dirk? You joined us together with Kaiser Capital Risk.
Yeah, end of 2020, beginning of 21, I guess.
Yeah. And this is when we met you. Right. Because after the due diligence we had, and I have to say, we're not newbies in reporting. Yeah, we came from corporate background. We knew about a balance sheet. We knew that you could do more things with Excel than one things. But still, during the due diligence, the planning and the reporting that we needed to do was put to a test, and it was too much for us to handle ourselves. And that's when we got together with you.
I still remember the first Excel file to make sense of your MRR. Like, what was the MRR? It was a long conversation. But I find it very funny that we're talking finance. Obviously, again, the Startup CFO, we're talking finance. The topic of the debate is fundraising and financial management from seed to Series B. But we keep talking about culture and human factors here, like how the software within the hardware company, or how if the spin-off, if the corporate is yes, let's do it, but then they don't allow to create a startup culture. In the end, I think that we work on very technical things, but what moves the needle is the culture and the human feeling behind everything. And a friend of mine, also an entrepreneur, he says always that startups lose money for a very long time because they are independent R&D departments. An R&D department in a corporate, it loses money. It's a cost center. It's keep dumping money. So a startup with the rights, with the independence, they are you can allow them to work independently. So they don't have any legacy. They don't have any inconveniences, any lag. And then once they're successful is when the corporate says I'm gonna put the money here that can accelerate. So yeah, that's fine. Also, I wanted to ask Dirk on this technical versus human. So he told us the investment thesis on the sectors and stuff and the phases. But I want to know as well the unofficial thesis. Okay, once they meet those criteria, who gets chosen to say okay, we give you a ticket? What's that besides the requirements? What moves the needle and says, okay, we believe you?
Well, this is, I mean, there's 2 answers to that. One, there is a general perspective on an early stage we see about, what the company, an attractive company, how an attractive company should look like. And then there are specific expectations that we have, right? So if we look at an early stage company, it's a big commitment actually that everybody's giving to the company, also the founders by themselves and the first employees. So everybody has to believe in a very big market and a very dominant market position of that company based on a defendable product or a defendable intellectual property or a defendable idea or a defendable land grab or whatsoever. So there has to be a lot of conviction on each side about this company to having the chance to really go through the roof and to be so successful that it has the capabilities actually to pay back a whole fund, right? So institutional VCs, they are working in most of them at least, and we work in funds. So we are deploying money that we've been given by our investors. Those funds have typically they follow the model 10+2, which means these funds run for 10 years and can be extended for 2 more, which means during this time, everything that we do, so investing, growing companies, exiting our positions, needs to happen during this time frame. So there's a very large number of criteria that we look at, and specifically also criteria that have to do with timing, right? So if you imagine, right, we're investing out of a fund, which might be in its, I don't know, 3rd year or so, which means there's a number of years left until which the company needs to have a certain position, and we need to exit at least our shareholding. So there's many characteristics here. When we talk about finance specifically, and in the early stages, I have to admit, in the very early days, you just want to get stuff running, right? So you just want to build your product. You just want to, win your very first customers. You want to make sure that you actually manage your payroll. This is super important, obviously. You manage your taxes. This is super important also. But everything else, I guess, has like a second is priority number 2 or 3.
I would even say it's suspicious if they have it like too much in order. It's like, okay, focus on selling something and having something here. And then usually when we arrive to companies, by definition, it's a mess, the finance side. But I'm like, it's okay. You were focusing on the right thing, and now we'll take care of this part. That totally makes sense.
Yeah, and this is also like if you ask me, like what our perspective is in the, in the different stages of a company, how do we look at the finances and controlling? It needs to be adequate to the phase. So as you said, if I had like a pre-seed investment, and I had like, I don't know, 50 internal processes from order to cash to travel and everything, I would think, does that company waste effort and time for their processes at that moment in time? And vice versa, in a later stage company, if I look at a Series A or B company, and they I don't know, they don't have their cash collection in order, that's a red flag as well. So it needs to be such that it actually fits the specific phase, because startups per se have to be super effective and efficient when it comes to their resources, being it people, the founders' time, money. So this super effectiveness is important, and you can see it if you look at companies.
Absolutely. By the way, we have a question in the chat, and again, happy to have as many as possible from any participant. So Andrew asked, do VC funds typically invest in competing startups? And I think in particular in cybersecurity, this is especially interesting. I would say that in cybersecurity, there are some funds that invest mainly or only in cybersecurity. There's certain use cases or frames that are not unlimited. So I guess more often than not, you guys find out can we invest, can we not? How do you guys address that?
I would say VC funds investing in competing startups is the exceptions. We don't. We don't because obviously, as I said, we are a long-time partner. Some people say it is as strong as a marriage. I say it's even stronger because you cannot get easily divorced if you have us on your cap table. So it's a really strong connection. And also over the lifetime, over these years, certainly companies also evolve and develop, and product portfolios develop, and the offering is, moving. So for us, it is important that we have specifically, if we look at a specific segment such as cybersecurity, we have our hypothesis about different segments that are becoming important in the coming years. And then we fill these segments with startups into which we believe 100%. And then we go full speed. So we don't we don't invest in competing startups.
And from our perspective as a startup, you also do due diligence as a startup on the VC. And maybe it has been a different market in the last months where money was so short. But when you start fundraising, you have a list of VCs that you're addressing, and you want to know whether they are in a conflict of interest with you. Because when push comes to shove, you need to, as Dirk said, you need to have them 100% behind you, and not saying, all right, these ones didn't, but we still have startup number B. And when you have that feeling, we would not have chosen that VC, and none of ours has a conflict of interest in their startups. There is still enough conflict of interest about where the money is going, where the attention in a board is going. So we wouldn't do that.
Makes sense. Yeah, that's again on the technical cold finance side versus the human side. Like, okay, like who do I want to be talking to on a weekly basis for the next 5 years? Is it someone that I trust? Is it someone that I could like talk unlimitedly? Also, I think that more rookie founders, I have to say, by the way, I'm 34. I'm like older than probably like 60 or 70% of our clients already. So and I see that many times they don't realize like this connection is so important, that they don't see it as partners, but rather like as the boss many times, the VC. And that creates, in my opinion, a bad relationship, because they are not. So like, let's treat each relationship as it really is. And this is a partnership. Like, you guys, from that moment on, you are shareholders in the same company. So certainly, if it's someone that you want to count on as a partner, and then like trust is not there, this would not go very far. Coming back a bit to the more technical part, though, on Build 38 in particular, when you guys started being a spin-off, you guys at the like you faced the problem of having a non-investable cap table at the beginning, right? I think it's a pretty good example of like also a problem that many like early stage founders face, or many companies that then want to become startup phase, or many spin-offs phase. And I think if you want to share it, it's a good example for many people in the audience.
Yeah, there are a lot of things you would do differently, or I would do differently at the beginning. And one of these things is looking early enough on the cap table. In the beginning of a startup, you have that feeling that what could possibly go wrong, heroes of the world and everything. And you don't look at these details, but it has been, as you said, a constant topic of discussion in every round. So when we started, our mother company was not really trusting the whole idea of startups and stuff. So they only gave us 30% of the company. With 30%, you're not a startup. You are minority shareholder in the daughter company of an enterprise. So after a few months and getting our feeling for the whole thing, we went back and said, look, this is not working. No one is taking us seriously. We need to change that. And that's when the family understood, and GD Ventures helped a lot in that. They changed, and they got us as founders into the majority seat, but still they own 38% of the cap table. So we have been trying in every round, first of all, of course, to get diluted as little as possible. That's the first thing that you always try to do, but also compensate to some extent with VSOP. That you have the possibility, at least for an exit case. And one thing you need to understand when you start getting VC money into your company, there will be an exit. That's another important thing that some of my peers did not understand. They just looked at the money and then thought, wow, we have money, but as Dirk said, a fund has an end. And in a VC business, there are very few that should be able to pay for the fund. It's different to PE or the corporate business that go in these businesses. But here you want to have an exit, and for that exit, you need to prepare eventually. So now with these techniques, like using VSOP programs, we try to compensate for that. And also the other part is that you need to be super careful on your cap table when it comes to funding and grants. When you have 25% of one investor or more than 25% of you, and you're not considered for the EU, for example, eligible for most of these grants, that are so important, especially for deep tech, to get. Only since we have the case that our largest investor and corporate investor is under 25%, we have access to these kind of things, and they are super important in combination with the money you get from VCs, the grants, the loan from banks. There are these other opportunities for you to fund, and they're non-dilutive. So for you, it's perfect as a founder.
Yeah, I think there's a very important point there also. You mentioned that if you have 30%, like if the management team has 30% of the company, that's not a startup, and I completely agree. I would add, though, that not everything needs to be a startup. That this is something that we see very often. That it seems to me now that you open a bakery shop in downtown Madrid, and people would already ask, like, but are you in seed or Series A? Are you fundraising now? How scalable is your model? Like, how much are you burning? Like, I'm burning bread, that's it. So, like, I think, like, there are many, and in my opinion, this is a question that, like, entrepreneurs should, like, think through before jumping into, like, the fad of startups. Is like, okay, is this really a startup? Do I want this to be really a startup? Because I think there are wonderful businesses and make a lot of sense that say, like, okay, you put the money, you put the work, you keep 70%, I keep 30%. Search funds operate that way, and many other companies. But yeah, it's like everything needs to be aligned. Like, if you want it to behave like a startup, then it needs to have the cap table of a startup.
I would like to, Jaime, if I may, you're both Christian and you are absolutely right. And I think this is a super important point, because if you're a founder, you really want to decide whether you want to go into the VC route or not. That's exactly what we are talking about now, right? Because if you're on the VC route, you are up for, like, very, very aggressive growth. Like, it is a bet that everybody needs to take, that the company is growing as significantly, and it can be it can become a very big player in your specific industry, in your specific field. And this comes with, as you said, with many specifics. So it's it's super high pressure, it's super intense, it's super competitive, and you need to decide actually that you want to do this. And luckily, there are enough brave founders who do that, sort of including Christian. But it should be a very deliberate decision. You don't want to get VC on board and then realize what you are actually up against.
Exactly. I think it should depend, again, on the technical and on the human. On the technical, is it the right business model? Because, like, it may be or it may not be. And, like, for example, in my case, I don't have venture capital and I'm fine. And in my opinion, we are a consulting business that it wouldn't make much sense. Like, could we turn into a product? Maybe. But, by now it's like, okay, not the only way. I know what I'm missing. I know what I could get. And on the human side, I always find it very funny that, like, I think people, like, over-celebrate many times the funding rounds. So I understand it's a huge effort. So I understand, like, a company gets 20 million, they have been working on it for between 6 and 12 months, and it's a huge effort, and I understand, like, congratulations, you wanted to get this. But then, if companies raise money, it's because they're going to spend it. So this makes sense. So, like, you raise 20 million, then you're going to start burning maybe 1 million per month. And then maybe at some point you have, like, 4 million in the bank, you spend 1 million per month, and then the figures don't look that good. And then it's like the stress in those situations, it's nuts. I mean, you as an entrepreneur yourself, and Christian definitely know more than me about this. But, like, we see our clients many times facing, like, okay, maybe we need to start firing people, and that's not cool. Maybe the huge plans we had, they're not gonna come true, or not gonna come true as soon as possible. So, like, is that something, like, are you sure you really want to get into that? And again, if the answer is yes, we need people that say yes.
Yeah.
But yeah, everything needs to fit in the same story.
Yeah, Jaime, there are a number of questions piling up. I think some are for me, and you know,
I was gonna go there too. Yeah, actually, I mean, if I'll read them, but I think they are mostly for you. I guess the guys that have the money are always more requested. So, would you, as a VC, invest in companies who come from venture building or corporate venture builder programs after Series A? I think this is also related with the percentages question that we had before.
Yes, yeah, and yes, but and yes, and the but both have already been explored by Christian, because he's coming out of the corporate environment. Actually, it's a spin out more or less, which needed to be structured such that is attractive actually for VC. So you know what we see, well, what we know, and that's why we look so carefully at the cap table. We know it is not, you know, from startup to, or from starting the company to success is not a straight line. We know it's going up and down. And when I was talking about growth, that's the other question here in the chat. We are actually talking, you know, after you come to like 1 million in annual revenues, still the expectation is that you double. So it will flatten later on. But we are talking about, you know, doubling the company like every year over the first years, and which also means that the organizational changes in the company, once you actually are growing, they also happen pretty fast, right? So you grow to a certain amount of people. Typically, if you reach like 50 employees, organizations change. The next change is happening after, I don't know, 100 people or so. So there's many changes going on. But the growth, as I said, really in these early phases, some companies, until they have 1 million, they grow like, I mean, if the numbers are small, right, it's rather easy to grow in big numbers. But in the end, if you know, as a ballpark, doubling each year would be something that we are actually looking for. And if it comes to accelerators or venture builders, you know, companies or startups coming out of those initiatives, they have a huge advantage, which is they've already, these founders have already run through such a program. They already had to present their company and their idea. They already have talked with coaches, and so this is an advantage actually. You know, getting off, you know, fast and prove your ideas. And so this has advantages for us specifically. Companies such as Build 38 coming out of the corporate environment, you know, these guys knew that there is a demand. I mean, they didn't just think there is a demand or have this vision or idea, but they knew it, right, from their business. So this is a big advantage. Obviously, what Christian was talking about, and you know, where the questions here also go to, there's a flip side, because you know, if done wrong, if not done good, the cap table doesn't work. And what I mean by doesn't work is that VVCs, because we know it's not a straight line to success, we know things will happen during the development of the company, which require commitment of you know, everybody, and specifically of the founding team and of the executive team. And so we try to have as much as possible active capital in the cap table, which means shares owned by individuals, by people who actually are working at the company. And this is also the sort of behind the idea of vesting, right? Of shares vesting, both shares as well as stock options. So the whole idea is you want to have, because the stakes are so high, and the road is you might struggle over the course of the development of the company. You want this full commitment. You want to have as much as possible, like active shares in the cap table.
Absolutely.
And that's the same for us as well. To be very open here, I want to have my fellow co-founders and my leadership team being bound to that company. If I don't have the opportunity to give them shares and include them in the cap table, either directly or with the VSOP plan, I need to pay them for that. And a lot of startups have failed in that, developing over a difficult time, And then the only thing that bound their CTO to the company was salary. And this is especially here in Munich, for example, you cannot compete with the salary structure in Munich. And also we cannot compete with the structure in Barcelona. But to be open, and there needs to be something different to give to them, and shares investing is the best option for it.
Yeah, also from the startup point of view, I guess if you have, imagine like 10% of your cap table is passive investors, or maybe like all business angels that you gave too much to, or a VC that is no longer like participating at all, then I guess it feels like 1 hour per day you're working for someone that doesn't care or that is not like collaborating. So I guess that's a feeling as well of like, I'm working a lot, so I'd rather do it for someone that is participating. Absolutely. So I guess on the questions, well, Dirk, you already answered like the last one, what is considered high growth? Well, you guys would expect to double even if the company is doing 1 million. Well, on the technical side of the related to the venture building question, there was a question saying, how do you see startups coming from accelerators that take a 25% equity? Is there a threshold that says like it's unattractive for VCs, like an accelerator took too much? Where would that be?
Well, as always, well, there are VCs who have certain thresholds, right?
Mm-hmm.
For us, it always depends. Well, 25% is certainly it's a very important number, because that is like the difference between having a controlling ownership and you know, the aspect Christian mentioned, whether it qualifies as an SME. So, well, I would say I would say more than 25% is a problem per se. So I do not say it's 10 or 15 or 5 or whatever, but above 25% is a problem per se.
Yeah,
Sorry.
and I would say, what kind of accelerator is that gets 25% of your company? From a founder's perspective, what are they doing? Yeah, for 25% of your company, a quarter of everything you're building today, you're responsible, and for the future, I want to see that accelerator. This is, in my opinion, bordering a scam if 25% are taken. Yeah, we have our big investors. They have been there from the beginning to the end. They've invested a lot of money for getting close to that number, and they are able to support you in the future as well. Something that Dirk mentioned, that their sweet spot, when he says their sweet spot is A, it doesn't mean it's only A and then we're out. You need them in the follow-up rounds as well. Also, to show to new investors that they don't see you as a lost cause. They will continue invest in the next stage for that. And I have never seen an accelerator doing that.
Perfect. And it has 2 questions. Well, I guess it's, they say for Dirk, but I guess it's in both sides. It's how closely do you work with the startups to advise and help them? Like, for example, 1 meeting per month. And a follow-up question, if you meet regularly, are these meetings with only the founders or also other C-level employees or other employees of the company?
I start, Christian, and then I think this question is directed to both of us. And you are actually able to give the better answer, because my answer will be we work with the startups as much as they need us. So that's what that means is, well, again, it depends on the stages. We have early stage startups, so which means we are also we know that we work a lot basically with some of the founders. We offer Joe fixes monthly, sometimes even weekly. I sometimes have founders like every week on the phone. We have monthly meetings and we have quarterly board meetings. Often these board meetings are extended, such that we talk about certain strategic topics, which is super important. So we work, as I said, as close as is necessary and as close as specifically the founders want. If things go, if the companies are in situations where things change, so either when there's a new financing round coming up or when things are not going so well, right? Then the discussion might be becoming much more intense.
Makes sense. Perfect. Moving on a bit.
Don't forget Christian. He's the more important one.
That's true. And he talks to more VCs, actually.
I met a VC the other day whose claim was, we are non-annoying capital. I like that very much. Yeah, non-annoying capital, because there is a lot of annoying capital as well. Yeah, when you realize at some point that the only discussion you have with your investors is about the yearly audit report or something, you're definitely on the wrong track here. What I have is, or what we want to have is non-annoying capital, but capital that you can turn to when you have a problem. And this is what Dirk means, that there are phases in our relationship where I call him every week, or where I call other investors every week for decisions I need to make in the leadership team, decisions I make on strategy or something, where I need to get their view. Because what you are lacking as a founder, you always think it's your problem. You're alone in your startup. What you want, and investors can give that to you, is the resilience that others have been in kind of these situations before. Yeah, you're not the only one who's screwing up. Yeah, you're not the only one who's not making the numbers. There are reasons for it, and you want to get advice on that. And this advice is what you get from them, because they have you and they have a portfolio of companies and they can connect you. There is often the saying that, or sometimes people think with an investor, they will get you new clients. This is not happening. Yeah, maybe you're lucky that someone has a new client for you in their LPs or something. Perfect. But this is not normal. They are not here to sell for you, but they are here to advise you on the decisions and become your trusted partner. And I'm very, very happy that we have that relationship. And when I look at the short dials of my phone, there is Dirk in it, there's my wife in it, and there's Michael in it, and unfortunately in that order.
I see. Well, Dirk is a nice guy, so I don't think that's too bad. But yeah, I see. Makes a lot of sense according to the needs. Also, another question. I think it's very interesting in deep tech. Like for Dirk, how much do you ask an early stage deep tech startup to be investable in both seed and Series A? I think, for example, Christian mentioned that the first client was like after you guys got started and already with the funding, even if it was a spin-off. So I guess if it's a deep tech project, like truly a deep tech, by the way, truly a deep tech project, the numbers, as you mentioned before, don't tell you much. And what do they need to demonstrate to gain your trust?
So I know that this may be a very, very long answer, and I make it short. And the reason being the term deep tech. So eCAPITAL is investing, and we are talking in the venture scene. We are mostly talking about software SaaS kind of businesses. Only recently, like about 2 years ago or 3 years ago, we were much more talking about like real deep technology, like whatever, quantum computers, drones, all this kind of stuff. So deep tech for us means like the whole range of technology that has a certain ingenuity, and we invest in companies such as Build 38, which is basically a software company, but also in other. So if we have hardware companies in our portfolio, we even have semiconductors company in our portfolio, and invest in companies which produce new materials. So they are very, very different. Super different, and also the criteria are super different. So when we talk about a deep tech kind of software company, which would fill into our definition, which might have a patented technology that is ingrained into a very specific software product, you can typically get customers and can get out into your market very, very early. On the other side, if you have a semiconductor startup where you are actually developing a new material that can be used for a new type of chip, you have a very, very different phases for your company. You have the so-called technology readiness levels that you are working with. So until this product is actually seeing the first real customer, it might already be Series B, in that regard. So it's very, very different. It's very individual. So the criteria are certainly very different. However, what is always important at this stage is that that a first addressable market has already been identified, that the problem has already been identified and is confirmed by your potential customers, and that we can see, as for a seed investment, that we can see that the technology and the product actually has a chance to be successful. So that's how I would characterize this phase, and I think this holds true for everybody.
Makes a lot of sense. Perfect. There were some follow-up questions, but I think they were answered by this. Moving on to the startup side and on the finance area. I would say that finance is a weird department in which the other departments are usually you hire the head, you hire the CTO and he builds the tech department. You hire the head of sales, maybe not on day one, maybe at the beginning there's a more junior sales, but pretty early on you hire a head of sales and then the team. And I would say that it happens with all departments, but finance. Finance is, I think, usually built bottom up. You have at the beginning only the accountants, then maybe you bring an office manager to help with invoices, then some controller, and at the end the CFO. So Christian, from the beginning, at least until now, how has that the finance department been evolving, and what role it played for you? Also, by the way, thinking that you as engineer and PhD probably didn't care much about the finance side yourself.
Well, as I said, I started my career with Ernst & Young. I did work for an auditor for 4 years. And if it was that easy, you just hire a CTO and everything falls in place. Well, it would be perfect. No, but what you're saying is to some extent then correct. That finance is evolving with you, and as the need is developing for it. So as I said, from the first Excel trials that were for the first business plans, but where you need to be, I would say before an A round, definitely before an A round, is that you are able to plan ahead in a way that is not raising questions because of how you plan. And there are a lot of things that you need to take into that model. And the model that we have built with you over these years is, it's complex. It's not overly complex, but it takes into consideration different regions, different salespeople, different kind of products. So it is something that is evolving, but the model needs to give you a prediction about the future, because the future is what you're selling to your investors in that round. And you're not saying, look, I've been already profitable for the last 10 years. Then you could go to a bank. What you need to do is show a model that is depicting the next, I would say, 12 months with a certainty, and then on top of that, it's a lot of wishful thinking and hope in there always. But to come to that point that you can rely on these figures, you're building that function in your company. And I see finance like what we're doing in operations. So we do not start with building immediately our own data center. There is something like the cloud. There are hyperscalers where we go into and start working with them, and then they are scaling with it. And that's the same, I would say, with you, or why we hired you in the first place. There was a reporting issue. There was a modeling issue that is evolving over time. And as we are getting bigger, that function is getting bigger. Yet we have not come to that point where we need our own CFO. That guy would be bored 50% of the time, at least. But what you need to have, and this is why I'm saying you cannot underestimate the role of finance, is to have that predictability for the next due diligence and for the next discussion with an investor. And then, yeah, you move that forward. But if you're going into due diligence and they're finding fault in every number you put in there, how do they trust the rest of your business? And that's why it needs to have that professionalism that we would also get for running our products on. You're not going to anyone, you're going to AWS, you're going to Azure or wherever to start your operations. So you should do the same thing for finances. Mm-hmm. And I don't see us really needing a CFO, a full-time CFO before any B round or something. Mm-hmm. It's still so much founder-led business. And the problem for us right now is not the reporting and not the modeling. It is the predictability of pipeline. And that has something to do with sales. And I think looking at my peers, it's always a problem. Yeah? Salespeople will tell you something that, but if you get, let's say, fuzzy numbers into your model, how do you expect them becoming crisp numbers to the second decimal in that process? That is not working.
Yeah, it's a garbage in, garbage out. That's exactly.
Yeah.
And again, I think it mixes the technical with the human. When you talked about trust, I always say that like the bad part of working in finance and especially in our role is that we can't win the game, but we can lose it. You know, so if you guys like are successful in the next funding round, it's not thanks to us. Like if your product is terrible and you guys are not selling, and you know, like things are falling apart, but our numbers are wonderful, we're not gonna win the game. But the opposite may happen. It's like you guys may have like a company and product and stuff, then the numbers don't make any sense. And going back to the trust that we were mentioning, that is mutual, obviously there's no trust. If it's like, how do these numbers add up, like the accounting and the management account here, or whatever. So
I'd like to add, Jaime, if I may, one thing, the perspective of like ourselves as an investor in a company, with regards to the finance function specifically. But before I do that, just for all of us, just remember, venture capital, we are a regulated industry, so we have a fiduciary responsibility for our investors. So there's certain things we just have to do, right? Because we are obliged to do that. And so if we look at the company, I said already in the very early stages, you know, we want them also to have the priorities right. So they should get stuff done and the payroll paid and taxes, and then they should move ahead and build their product and find their very first enthusiast customers. But it evolves obviously over time. And when we look at companies, you know, we take big decisions, you know, with limited information. And one important piece of information is how the company has actually built its business model, right? So how the planning has actually been done, right? Have they just copied something, or, you know, how much thought did they spend in, you know, extrapolating anything from the past into the future? What's their thinking? What's their culture there? So this is an important element that we find like immediately, like we see thousands of companies every year. So we see this immediately if we go into a business plan discussion. And so this is also something that says something about your company, how you build your stuff, how much attention do you pay to certain elements of your business model. And this changes over time. So if you are later, like Series A or B, something like strategic finance comes into play because you have to use all kind of financing instruments that are out there in order to finance. You certainly need to, in these days, and happily these days, you need to look at efficient growth. So the efficiency element came back into play like about 2 years ago or so. And so for that, you need metrics that tell you something that you can use to actually manage your company. Forecasting is a very important element that Christian also mentioned, right? And so these are then elements which show that you are becoming more mature as a company. And this does not stop very soon. So you're becoming more and more mature. And with that, also the accounting and financial department needs to become more and more professional. there is this question of like, when do you need your own CFO? There are companies who actually hire their first CFO very, very late. And there are others who have them like in the founding team. I think everything works, right? For us, we just, want the company to actually, be on top of their numbers.
Absolutely. Yeah. That you raised a point that I always say, even to like seed or pre-seed founders. So we are like, I tell them like, you need a business plan. And it's like, don't worry, nobody believes the business plan. Like you're telling me you're going to tackle a huge market with a new technology, with a huge uncertainty and stuff. It's like the fact that like you're telling me that in 5 years your revenue is going to be 14 million or 13. To be honest, like it doesn't matter that much. But they're judging you. So even like on those numbers, it's like, okay, like does it make sense? Like the levers of the business, like did they think them through? And does it make sense? It's all right. Even how it's presented, like, is this guy like someone that, like does things like quick and dirty, or if you ask him for something like presents this, will they behave that way with the clients? So I think like all this like shows a lot about the people that run it. There are a couple of questions, but we are just in time, and actually I'm 100% sure you guys have new calls now after these webinars, because their schedules are super busy. So, well, thank you very much. I think there was like a lot of content. I like it when there's like opinions that are like with full of content, that someone could say the opposite. And I think there were many. And again, thank you very much for your time.
I thank you, Jaime, for the invitation, and of course, Christian, but most of all to the audience. So thank you so much for this broad audience and for your interest and for your questions. If you want to reach out to us, so very easy through Jaime, and happy to also like answer like the last questions offline. Thank you, guys.
Thank you.
Thank you very much.
Thank you very much. It was a pleasure.
Bye, everyone. Thanks for attending.